our VC insights on COVID-19. I'd like to thank our panelists in advance and welcome our host, Catherine McConnell, to get you started today.
Okay, welcome everyone. We can see there's 40 participants, so great to have you all online. So I am the founder and CEO of Bright, where I've been a member of Fintech Australia, I think, since the very beginning. And so one thing I want to say before I start is just congrats and thank you to Rebecca, who's been doing an absolutely fantastic job of supporting ourselves and all of the other members. So I know she works tirelessly, working with Treasury and working with, so whether it's Senator Hume, but all the different members to really support our interests. So thank you so much for the fantastic work you're doing. We're a business we started 3 years ago. COVID for us, is the first really, big crises, I guess, that we've had to handle. And so, the last 6 weeks have definitely been challenging for Bright. And that's why I'm really keen today to hear about the VCs. So I think we've got the Illuminati or the, Sydney royalty of VCs on the line here today. And so I'll just introduce them all one by one. So first we've got Melissa Widner, Managing Partner at NAB Ventures. They've invested in some amazing companies, so she can talk to the company she's invested in. But I have known Melissa for a few years and first met Melissa. She co-founded Heads Over Heels, and I was really fortunate to be selected as one of the participants of the program and got immense value. So I'll just hand it over to Melissa to do an intro.
Yeah, thanks, Catherine. And we're so happy to have you as a Heads Over Heels portfolio company. And also, as I know, NAB provides some of the funding that Bright uses, and it's just been amazing to watch your progress. So I am, as Rebecca said, the Managing Director of NAB Ventures. We've been around for 4 years now. We have invested in 18 companies here and overseas, primarily the US, and we're actually in the middle of investing in 2 more, so there's activity going on. Prior to my time in venture, I've been in venture for almost 2 decades now. I was an entrepreneur. I started and ran an enterprise software company in Silicon Valley that today would be called a fintech, but that term didn't exist back then.
Thank you, Melissa. I did have a note actually that you do understand both sides. So you understand the entrepreneur's journey and also, the investor's journey. So it'll be great to hear your insights today. And also, yeah, thank you. NAB has been a fantastic partner. I always say #more than money. So, thanks for your support. So next, introducing Simon Cant. So Simon's co-founder and managing partner of Reinventure. Bright first started its journey at Stone and Chalk in late 2015, and I'd have to say that Simon was the first person from a VC that I met. And so Reinventure also, I think, may have started as well, or early days at Stone and Chalk. So has invested in some amazing companies. And so handing it over to you, Simon.
Yeah, thank you, Catherine. So we've been going since about 2014. The beginning of 2014, and yeah, we had a pretty leading hand in kind of kicking off Stone and Chalk and actually also Fintech Australia. So we've been sort of big ecosystem builders in our time, and we've got about 30 investments to date, about 150 million of funds that we manage. And yeah, prior to this, look, I did VC first time around back in the .com era, and actually, it almost turned me off capitalism altogether. So I went and did venture philanthropy for the next 5 years with Social Ventures Australia. But I've found my way back into it, and it's been an amazing journey. I think this last 5-6 years, and I would say this is definitely a massive kind of make or break point for, I think, the startup community in this country. And I hope it's the make point. I really do. And yeah, look, really great to be part of this, and hopefully we can share some insights into what we're seeing in this market.
Thanks, Simon. I echo, I do hope that it is a point for FinTech to prove that our high growth is not because we've been reckless, but our high growth is here to stay. And, we can be fantastic citizens and supporters of our customers. So thanks, Simon. Now, I don't have favourites. but I do have to say and disclose that one of the panelists has invested in Bright, and I'm sure they don't have favourites either. But if they did. So just introducing James Cameron. He's a partner at Airtree. I also met James early on in my journey. James has sat on the boards on some different, fintechs, and has that experience also working in startups and then also being an investor. So I'll hand it over to you, James.
Thanks, Catherine. And we definitely do have favourites. In fact, we have like a leader tally board in our office, and then we move them around from week to week. I think you're pretty close to the top. I'll have to check when I'm back in. Thank you for the intro. So Airtree, we're not a sole fintech focused firm. We're industry agnostic. We invest in everything from education to healthcare to fintech. I think the common thread amongst what we look for are founders who really have ambitions to build very large businesses, and clearly fintech is a huge part of that. We've got a reasonably large portfolio in fintech. Obviously, we're very proud investors in Bright. We're also investors in Athena and Prosper and Spaceship. Most of the investments we make are global. In fintech is one of those areas we are very happy to make investments in companies that are focused on building large local businesses, because it's one of those areas where you can still build a massive venture-backed business. So we try and make large sort of concentrated bets on companies that we think can really become category leaders in fintech. We try and do that early. We're kind of stage agnostic as well, but we'll back any companies. We love to come in sort of seed and Series A, and then we try and back companies all the way through. We've got about $700 million under management, so we try and be able to be there for companies across multiple rounds. And I joined the team about 3 years ago. I used to work for a US fund called Accel Partners, but I was based in the London office for Accel. So we were kind of in London when it felt like it was ground zero for fintech 1.0, and we were lucky enough to back great leaders in the space there, like Monzo and Funding Circle, and we also had our scars from blowing up a lot of money in companies like Wonga. So the whole gamut. And before I joined Accel, I was also running a fintech startup in San Francisco. We were selling research management software to hedge funds and mutual funds and the like. And it was a tough journey, to be honest. There was a lot of pain involved. So I sort of know a lot of the ups and downs, and had scars from running a fintech business.
Okay, so thanks everyone for the intros. Just the format for today. So we've got some questions that I'll be introducing some discussion with the panelists. We've also got about 15 minutes or so at the end to take questions from everyone. So you can either use the Q&A at the bottom to ask the question, or you can put it in the chat section as we go. So getting started with the questions. So it's been almost 6 weeks, so since the COVID, so since the crisis started. I know for Bright, we started, looking at what was happening at the end of Feb, and at the start of March, we started going like, is this the GFC? So it'd be really interesting to hear your experiences and your observations about what you're seeing in the market, as far as what's transpired. So I might just start it off just in the order of Melissa first, to see if you've got anything.
Yeah, so the question, is this the GFC? It's feeling a lot like the tech wreck to me. So I joined a venture capital firm in the US in the beginning of 2000, and things were still fun and wild. And then in March 24th, 2000, the stock market started to go down, the NASDAQ, which it hadn't done in a long time. And that was the primary path to liquidity at the time for venture-backed companies. But it was kind of a slow death. It wasn't until September 11th, the following year. So it was really like 17 months where, the venture funding was really declining, and people were taking drastic measurements with their portfolio companies. And this feels like the last 6 weeks, to me, feels like that 17-month period. So it's just very compressed. And there could be, you know, if we really are headed to a recession, which is what NAB's chief economist, Alan Oster, says. He says we should be able to avoid a depression, but we are heading for a recession. If that is the case, then there are some silver lining and there's some advantages to this all happening quickly. And one of the things that's different today versus the tech wreck is there are a lot of safety nets for people and for companies. You know, the Job Keepers Act, I wasn't in Australia, but I don't think anything like that existed in 2001 when things were blowing up. So there are a lot of safety nets to help keep our companies going. But, you know, the last 6 weeks have been, you know, companies where we typically would have board meetings quarterly. There's some of them where we're getting together as a board 2 to 3 times a week.
Melissa, maybe one question. So you mentioned that the last 6 weeks, and you'd liken them to the 17-month period in the tech wreck. Where would you say in that 17-month period, where would you say we are? Given it's compressed, yeah.
Yeah, it does actually. Everything is so compressed that every day feels almost different. I'm sure it's like that for a lot of people. But one of our companies that is doing really well, but was in the middle of a capital raise, and they're a company growing fast and burning a lot of money, you know, that's probably one that would be most at risk, just because they're still dependent on large amounts of capital, which, you know, 2 months ago wouldn't have been an issue because they have such good growth. But they just got a term sheet. And it wasn't, you know, it was a good term sheet. Not as good as it would have been maybe a few months ago, but it was still a good term sheet. And we're not seeing things like we started to see in the early 2000s, which are really onerous terms for portfolio companies. Things like multiple liquidation preferences, washouts of previous investors. So that hasn't happened. So I would say we're hopefully we won't get there, and we're not there yet. But I would say the last week it is starting to feel like there's light at the end of the tunnel.
Thank you. Thanks, Melissa. So I might go, Simon, any observations?
Yeah, I mean, I think it is a bit different. I recall that period as well. And I think the differences are, you know, I mean, a lot of the ventures at that time, the fundamental kind of demand and economics for the ventures didn't change dramatically overnight. What changed was the capital just dried up. There was just no money to fund them. And we're in this weird period where we're actually watching our ventures. As Melissa said, you know, we're in touch with them on a week-by-week basis to see what's happening to demand for their product, particularly those that have got consumer or SME direct exposure. So, you know, I would say, I think a lot of VCs certainly encouraged their companies to act early. And there was the sort of pretty well-known Sequoia note that went out, and a bunch of others who really kind of rang the bell and said, act fast, you know, make cuts. And so, you know, I think most of our ventures that were in any way exposed absolutely did that. And I think I would say that we're glad we did that, and that we're probably generally pleasantly surprised that our worst case scenarios haven't sort of realized at this point. So I'd say generally it's not as bad yet as we thought it could be. But Melissa's also right. There was a very kind of slow hedonic reset in after the .com bust, when people were like, oh, maybe this is just for a little while, or maybe it's, you know, yeah. And it just kind of got worse and worse and worse and worse over a kind of 2-year period. It's who knows what's going to happen in this one. My hope is that it won't look like that, but certainly the banks are putting out some pretty ominous predictions, and the bank analysts are putting out even more ominous predictions. So it's really hard to know. But one thing I guess, well, we're going to talk about, I guess, how it comes back, or how we think it might come back at the end. So we can talk more about that there. But yeah, I would say 6 weeks in, the thing that I think just on a global scale is most concerning, you know, I think in fintech to some extent, it's a reasonably insulated market, but ultimately everything is deeply connected. And I think the most worrying thing is that there's been a deep loss of trust in as far as global leadership is concerned. I think there's been a deep loss of faith in the US and a deep loss of faith in China. And so the world is feeling a little kind of rudderless. Not that the world needs a leading country or a superpower to lead, but it will be a different dynamic for us to operate in a world that doesn't have that. And at the moment, it's feeling pretty rudderless, I would say. So that, to my mind, I think Australia's actually come through pretty well so far. But I'm very concerned about the sort of state of kind of global politics and geopolitics after this.
Yeah, I think that's interesting, Simon, because you have seen rudderless from the perspective, not just politics, but even the NGOs, like a World Health Organization or a United Nations, their role hasn't been as dominant and it's potentially being questioned. So there's not even a really credible or obvious alternative at this stage, is there?
No.
James, so what are your observations?
I think, we spent, I guess, the last certainly the first 3 or 4 weeks of this period, sort of pretty deep in the trenches with the portfolio. I think, my first observation is there's an incredible sort of human element to all this. There's an incredible amount of anxiety and stress and, sort of mental health issues involved at startups. In good times, the numbers are through the roof, and in bad times, when we're in a backwards market, those numbers only go higher. So we've been spending a lot of time trying to help portfolio and help founders outside of that just sort of steady the ship and look after themselves in that respect. Sort of fitting your own oxygen mask before you can go out and help the rest of the team or the company. So I think that's a big important thing. I think we're sort of seeing amongst founders, we're sort of seeing a tale of 3 groups emerge. There's some founders that are in the really, unique position that there's massive structural tailwinds, at least in the short term, behind them. Anyone in online education, remote work, all the obvious ones, companies like Canva and a Cloud Guru on training and Hotdoc in our portfolio, they're all up, huge amounts just in the last 6 weeks. So they're all sort of laughing. I think there's another group that obviously has really felt the crunch when their sort of demand has just evaporated overnight. Anyone in travel, anyone in in retail, there's a huge amount of shocks there. I think there's the group in the middle that sort of it's a little too early to tell, and a lot of those founders who are in enterprise sales or in other businesses that don't have an immediate demand shock. Some of them, they hit their Q1 targets and they're feeling pretty good about themselves. And I think actually the companies in that bucket sometimes will be the ones who are in most precarious position, because the incentive is less there to cut early and cut fast. And I think I've sort of been playing the role of the Uber bear amongst our boards, trying to really get them to focus on the second and third order effects of this demand shock that may not have hit them yet, but may well come down the track. And I think, I am generally a bit worried. I think when we compare this to where we were at the GFC, and even in the tech wreck, I think what structurally, in retrospect, what was really beneficial for the tech industry in general, coming off the back of both of those crises, was there was really obvious and big macro platform shifts that companies could get on board. In early 2000s, we had sort of the birth of consumer internet, and in the GFC, we saw mobile and cloud really drive a lot of the investment, a lot of the value creation in the tech sector. Really didn't, AWS got started in 2006, and the first iPhone came out in 2007. So the pumps were primed for a lot of quite obvious platform innovation. All you really had to do in that area, sort of coming out of the GFC, was think of a financial product that hadn't been put onto the mobile yet, or hadn't been based in the cloud, or an enterprise workflow that hadn't been put in the cloud, and do that, and you were creating real value. I think now that platform shift is less obvious, or at least you have to sort of think outside the box a little bit. There's huge trends around digitalization of the economy. Everything's connected. We've got APIs into absolutely everything, but the key platform shifts are less clear cut. So you have to think a little bit innovatively around how you can benefit from this, whereas previously I think it was was more obvious. So I think for that reason, I think there will be companies that come out of this really roaring and really slingshot out of this. But I think for your average startup, it's probably a longer recovery than what we saw certainly in the GFC.
Thanks, James. I think you're also starting to touch on one of the next questions. So I might see if you want to, elaborate on anything. But it's just so, specific subsectors in fintech that have been impacted more than others.
Yeah, I mean, I think we'll see. I think there are a lot of startups in the consumer fintech space that have seen actually a sort of a short-term boost. I think we're seeing a lot of really heavy engagements in consumer fintech. The stats I saw recently around a lot of sort of personal finance apps, wealth management, etc., the engagement has been up 20-30% overall in terms of total minutes. I think on the and that's really just, I think, people being at home and being able to focus on this sort of thing. I think there's on the flip side, it's still a little bit harder to do that initial customer acquisition. I think we're seeing, for the most part, the numbers out of the neobanks, for example, in the UK, actual new installs or growth of the new installs is coming down. So I think they were obviously growing very, very quickly, and a lot of that comes down to marketing spend, but we may expect to see a hit there. I think the lending businesses, that there's certainly a hit in terms of the credit cycle. We'll expect to see various degrees of hits across that part of the portfolio. For the most part, I think the really interesting parts there are for the companies that get through it and have enough runway and liquidity to come out the other side of this. There should very well be gold bars sort of sitting around everywhere. I think the businesses that can move through that will start to realise, as they did at the end of the GFC, that a lot of the banks and larger incumbents are pulling back from a lot of the lending businesses and lending areas. And I think that we saw at the end of the GFC that the credit and risk teams in the big banks just became so much more prominent. That the voice that they had around the table in any key decisions was so much louder. And Simon and Melissa will be able to talk to this a lot more about NAB and Westpac. And the innovation drivers in some of those businesses became sort of less politically persuasive internally. And so I think that there was a huge opportunity. I mean, fintech was effectively created in the GFC, and that came off the back of lending businesses for the most part. There will be a huge driver for that again for the businesses that can wait this period out. I think you're on mute, Catherine.
I might just pose this question to Simon, also Melissa, but what specific subsectors in fintech do you see that may be impacted on a bigger scale?
Yeah, what are you doing talking about what the banks are doing, James? So there is a sort of double whammy for the banks in Australia with the Royal Commission and now this. But what's interesting, we're not seeing a pull away from innovation at this point, but we are. What NAB has done and has announced publicly is they've gone from having 120 projects to 19 that we're focused on. So that would seem like a like pulling away, but what's happening is those projects are getting the kind of attention that they should have, and red tape is being cut through, and things are happening so quickly, which is wonderful. I mean, I don't know if you've seen, there's a meme going around that says, what was responsible for the digitization of your company? And one says it's CEO, it's chair, or COVID-19, and COVID-19 is circled, which is, we're seeing that happen in real life. One example, there's a product that NAB had been trying to get out, and I'm not across it exactly, but it had to do with, in order to access your Centrelink payment, you had to physically show something from the bank, and it just made it cumbersome, where it could be digitized and it could be a lot easier to do. And we'd had it on our product roadmap, kept getting deprioritized, and it was going to cost $2 million. And that was one of the issues, was funding and time and resources. Well, we just got it done a few weeks ago in a weekend, and it didn't cost $2 million. So there's innovation going on out of necessity. inside banks, and we're seeing that. NAB's CEO, we've got a new CEO, Ross McEwen, in December of this year. He actually became the CEO of RBS, which was one of the banks that was the worst hit out of the GFC and was responsible for turning it around. So it's great to have him at the helm. And I would not say, we're seeing any pull away from innovation, which is great, because that would be a fear in something like this happening. We're sort of seeing the opposite right now, which is nice. And then just, Catherine, in terms of your question on the sectors, one of our portfolio companies is called Home Time. They're the largest short-term Airbnb property management company in Australia, just doing fantastically huge growth. And their business got killed overnight, right? I mean, they've been able to make some adjustments, but it's not even legal to stay in Airbnbs anymore. So luckily, they were in a very good cash position. They had just raised, and they were able to right size. They got on top of it right away, able to right size their expenses. So they'll be able to see this through. And we know eventually people are going to travel again, but travel's really hard hit, obviously. And on the other side, some of our companies that are in lending, one of our companies is EdStart. They provide loans to people for private school fees. So demand has gone up for that. Lighter Capital is another one of our companies that provides revenue-based financing to tech companies with recurring revenue. And as other capital sources dry up, they had more MQLs last month than in the history of their company. So, we don't know what defaults will look like, but we're seeing good demand. We have a company in cybersecurity called Digital Shadows. Their business so far hasn't been hit at all. It seems like cybersecurity, especially around threat intelligence, is something big corporations aren't cutting right now, and in fact doubling down on. So there are ones benefiting, but on the whole, more are more being negatively impacted.
Mm-hmm. So Simon, in the interest of time, did you have anything to add on this one, or?
Yeah, look, I mean, I think that some areas that are probably a bit at risk, and I think it's there's an interesting time here where I think the government has to be a little bit careful about some of the moves it makes. So I think some of the super funds, for example, are in some of the new next gen super funds are in a pretty uneasy place right now, where they're about to face a whole bunch of withdrawals that were theoretically never even conceived possible when they were started. And that could leave them, particularly when they've got a large client base of younger people, I think that could leave them exposed. Look, I mean, a great story for us, to be honest, has been Indebted, obviously, which is a debt collection business. And it's different from, it's a transformation of the way debt collection has historically which has been, people approaching people either by phone or other ways, and has, not always had a particularly good flavor about it. Indebted measure to the extent that someone deals with a person at all, and typically people deal in whatever way they want to deal. So if they only want to deal with, messaging over their particular favorite messaging channel, that's how they'll deal. But to the extent that they have to deal with a person, that person will be rated on borrower's rating of them as customer satisfaction, rather than how many debts they collected. And, I think there are some of these real transformations that will get real energy behind them, because, at a time when a lot of people are being exposed to bad debts, the way people are treated in that process is probably more important than ever. So, they're seeing great tailwinds. Bitcoin is seeing more trading at the moment than it did in its peak in 2017, like by a factor of 3 or 4. So, there's some interesting things that are doing well out of it. But yeah, there are also, I think, a lot of the lending sectors have been hit. So probably not much more to add there.
Yeah, no, that's Simon, you mentioned Indebted. That's a fantastic business, and it's great that Josh and the team will be going well now. And hardship and collections, such a difficult thing to navigate, and it's top of mind now for anyone who's been impacted. But yeah, good luck to Josh and the team. So I do think, Melissa, you used the word right sizing. And so that is a word that we've been using a lot over the last 6 weeks. And I'm sure it is a word that most of the people dialed in today would have to have used as they think about, what the next 12, 18 months looks like. And I think, when you think of right sizing, you mentioned, Melissa, also focus. And so focus is something you have to think of when you right size and you look at all the uncertainty. You do have to commit to only a certain number of things. You can't commit to everything you were looking at in a growth stage. But I think, maybe if I could get, a minute answers from all of you, but I'm really interested in specific advice that you would have for founders and, how we should think about navigating the crisis. So might start off there with James. There you go. You're on the main screen.
I'm on the clock. I'll be quick. I think we've talked about some of the key ones. Act quickly if you're going to act. Think through the second and third order effects. If you're just because your demand hasn't evaporated overnight, really look closely at your pipeline and sort of the early indicators of demand down the track. Obviously, for all the fintech businesses, it's critically important to have a very strong and transparent dialogue with your investors on both the equity and the debt side. And then I think we've obviously all of the startups here will have probably run scenario tests on their P&L, thinking through cash burn and runway and revenue and all of that. And obviously, that's job number one in a crisis like this. I would urge everybody to start thinking about ways that they could similarly scenario test their strategy and their product roadmap. I mean, I think that the one thing that startups really have in their favor in this crisis like this is they are, they're anti-fragile in that classic Taleb sense of the word, and that you can come out of this sort of change and uncertainty stronger because you are more nimble. And so use that to your advantage and try to anticipate where things might be shifting in terms of your user behavior and what you can do to come out of this crisis with a better product, higher NPS, and place for better momentum on the upswing.
Thanks, James. Might move to Melissa. What's your advice for founders?
Well, I think I don't have a lot to add to that. Move quickly is so key. Things that we saw really hurting companies in the tech wreck was a slow cuts, doing multiple cuts versus, just doing it in one fell swoop, making sure everybody that remains knows they're the ones that, are there to get the company through this phase and to the next phase. And that's just so key. We hear that a lot, but even hearing that a lot, we don't see, I'm hearing some companies say, okay, first we're going to do this cut, and then if this doesn't happen, we're going to do this. And that's just very detrimental to the company's culture, which at the end of the day, if that isn't working, it's hard to get anything else to work. So not really. I think James did a good job of describing what companies should be focused on now.
Thanks, Melissa. Simon?
I mean, the only thing I'd add probably is, I think people become acculturated they kind of learn what's the process for growing a startup. And in a time where venture capital funding is reasonably abundant, you sort of learn that if I hit X, then I'll be rewarded with, this funding, et cetera, et cetera. I think that, there are a bunch of funds, Ettri's, recently raised. So there are a bunch of funds that have got a lot of dry powder at the moment, but it is, I think, very hard to know what the venture environment will look like in 18 months' time still. And I think it would be smart for companies to plan as far as possible that if they need to get to break even, that they can, and that as far as possible, they're working much closer to a break even type growth model than any kind of aggressive, let's just add people. I don't think that's going to be rewarded as it has been rewarded typically to date. I think what will be rewarded is close to profitable, if not profitable growth. And, there are some of the biggest companies. Atlassian was a bootstrap company that grew profitably for most of its time. So, that's what companies should aim for. And that there is a version of normal that looks like that, and companies should be working towards that.
Yeah, absolutely.
And so this goes on to the next question. So it's one of the questions we have, but Dan has also come through the chat section. So we've got the same question, but if there's a startup that's looking at raising capital now, or they're in the process of raising capital, what's the best approach to do this? And I might ask Melissa to start, because you mentioned it was home time. So you've just worked with a company, was it Home Time, who have just closed around?
Well, they closed a few months ago. So they closed
yeah.
at the end of last year. So they have a
Okay.
nice cash position. But so I was looking at the AIC, which is formerly AvCal, their report just came out, their 2020 report, which is the report on venture activity in Australia for 2019, just was released publicly today. And if you look at the last 5 years, so 2015 through 2019, the average amount of money raised by venture capital firms, not deployed by venture capital firms, but raised by venture capital firms, was about 550 million per year. And it was pretty, 2016 was really large. Last year, 2019 was 632, but it's been a really good 5 years. In Australia. And if we look at 2020, what's going to happen in 2020, I think Blackbird, if they haven't already, they're going to get off at least an $80 million fund, but I think we'll see some others pull back. So we're probably going to have, and we don't know this exactly, but I would guess we're probably going to have about 200 million in new capital raised. And you have to remember, about 10 to 20% of that goes to fees. So in terms of new capital that's available to be deployed, it's going to probably look like a third of what we've had over the past 5 years going forward, and potentially even less than that, because what we saw after the dot-com bust was companies, even with were raising subsequent funds to protect the good companies in their 99 2000 funds that couldn't get external funding. We live in a world where we rely on, if the company's doing well, you'll get a new investor to price the next round, and that you're going to be investing your pro rata if it's a company that you're still supporting. But what happens when there's not external funding is that companies have to really focus on their own portfolio, which means potentially less of this smaller pool of new money that's raised will be available for new funding. Another thing that Australia has been able to rely on in the last few years, or several years really, is as our companies grow into their Series B and C, and if they're doing well, there are overseas funds coming who have big checkbooks ready to invest. And I don't know this, but I think that will probably dry up, because those funds will be focused on their home markets more. So I think that we can assume that funding will be more difficult to come by. And that's not necessarily a terrible story, because we all know that when we are forced to focus, we just do a better job. And the companies that can get through this will have less competition. They'll have better products and better teams.
Thanks, Melissa. Simon, what's your advice?
Look, I mean, the main piece of advice would be stay close to your existing investors. I mean, at this stage, your existing investors is where your funding is going to have to come from for 99% of companies. And the reality is your existing investors are going to be more selective than ever. So a lot of, I think, investors are going through a very kind of Darwinian process of working out which of their companies they can really afford to, put their limited dry powder behind, and which of them they're going to have to pull back from. So that's where companies need to start. This is for companies that are that are being hit by it in a negative way. For those that are being hit by it in a positive way, I think they'll still be able to raise new capital. There is still new capital out there. It's hard to know. I think, as Melissa says, it's hard to know how true that will be in 2 years' time, or 18 months' time. I think the other thing I'd say to them is, when you do raise with your investors, make sure you give yourself 18 months of runway. You need to be able to get to the other side of this moat. And the last thing you want to be doing is going back to your investors in 6 months' time saying, I need more, because, we didn't get enough last time, because things could be a lot worse then. And, there's a dynamic in continuing to go back and back and back for more money, which is not a good way to approach it. So I would say to companies, make sure you're close to your existing investors, get them to work out what the terms need to be to get money behind you, and give yourself 18 months of runway.
So you think, in summary, maybe, firstly, right size.
I mean, I think
the different scenarios.
Right size is absolutely critical. And look, I think people should, there's a positive, there is absolutely a positive to right sizing. I think companies can become, they can stop making difficult choices when there's actually too much money available. And sometimes that excess stuff that is done is really not adding to the growth of the company. So I think this will, Melissa made the point, this will make companies stronger. I honestly believe that. But it is, as James talked about earlier, humanly, it's very painful. And I think for a lot of founders, they're not dealing with staff, they're dealing with some version of a family or community, and these are really difficult times to deal with that. But I think the faster you get that work done and get people set off on a new path, get the people who are staying with you focused on where they're going and rebuilding their optimism for the future of the business, the better.
So I've just got 2 more questions, and then we'll go into the Q&A. But I'll go to Melissa again first. What do you think the post-COVID recovery looks like? You mentioned this tech wreck of a 17-month period. So, when we emerge, what do you think it's going to look like? And so how do you see fintechs emerging, or what do you think they're going to look like post-recovery? Is it going to be a different type of fintech industry we're facing?
Well, and just to be clear, the tech wreck wasn't 17 months. It just was 17 months before people really realized the party was over. And then it was a long time before things started getting better. It was years. It was really, you have a few outliers, but it was sort of 2005, 2006, 2007 before things were just recovering when the GFC hit for venture-backed companies. So it was a longer period of time. I don't know. No one has seen this really. I've listened to and read everything I can, but the reality is even our economists haven't seen this. So is this just a blip that once social distancing is over, the economy can recover quickly? We don't know that yet. My biggest concern for the Australian market, although it's not as big a concern as it would be, say, a year ago, if this had happened a year ago, is that the superannuation funds are really starting to invest in this asset class, which is wonderful. When I came here in 2009, I couldn't believe that we had the 4th largest pool of assets in the world. And on a per capita basis for venture dollars invested, we were one of the lowest of the developed countries. And that's because superannuation funds weren't investing in this asset class because they believed you couldn't make money in Australian venture. And now we have some great things happening in Australian venture, but it's kind of too early to have the returns. So, you're not going to see those typically for 10 years. And when you think about our funds, started raising in earnest sort of in 2013, 14, 15, and 16, we're not going to see those returns till later. So I'd hate to see the superannuation funds pull back. I said I'm less worried than I was a year ago because we do have a great success story. I think there's lots of success stories about to happen, but we have one that's already happened with Blackbird returning returning 3 times their funds so far and still having a lot left that they haven't returned. So, and there was superannuation money there. So hopefully we won't see superannuation funds pulling back from this asset class, because that could put us back to almost ground zero in Australia if you think about where we were in 2009 and 2010.
Yeah,
I might ask Simon. Yeah,
you've seen a bit of kind of unpleasant sort of schadenfreude going on around funds like Host Plus, I think, who have been great champions of the Australian venture community. And, all of those funds that have had more conservative allocations, I think they made some very sensible choices when you have a young superannuation group to say, well, we're going to put most of our funds into really long-term asset classes. And I don't think anybody could see that the government was going to change the rules, except that the government is always tinkering with superannuation in a really unfortunate way. But I don't think anyone could foresee that they would change it in this way. So I'm very concerned about what happens with the super funds. I guess for the broader economy, and one thing I would say, if people want to get behind it, Michelle Decker made a really good point at a session I was at the other day, which is it would be, because the super funds actually have a pretty decent allocation to venture. They just don't have most of it in Australia. And, it would be really great to see the government at least giving superannuation holders the ability to indicate that they want their super put into Australian venture, or even potentially stronger to say that certain amount of super gets put into Australia venture. And I can tell you that a very small, what seems like a potentially seemingly small regulatory point like that would be absolutely transformative for this industry and potentially for the country. So I think it's something that all ventures should be concerned about. The only other point I would make is, it is very difficult to tell. This doesn't necessarily look like anything in particular that's happened in the past. People are equating it. It doesn't look like a GFC or a 2000, because that was a complete loss of faith in a given asset class at that particular time. And this is not a loss of faith in an asset class. This is an external shock. So in that sense, it is more like a war type scenario. The hopeful thing is that typically governments, because what makes an economy work is not just the relationship between financial markets and the economy, but between the government, financial markets and the economy, which is Bill Janeway talks about that quite a bit. Ray Dalio talks about it quite a bit. And there's some interesting people to read when you're thinking about this stuff. It's really how the governments globally act in this time. And in Australia, I think for Australian fintech, it's particularly important. That will determine most how we come out of this. Obviously consumer confidence will as well. The government has talked, we were discussing before the call, the G8 heads of the universities have come out, and there's two sort of pathways they've presented the government with, one of which is an eliminate the virus altogether in Australia pathway, which would see us in lockdown until June. And then the other is an adapt. So how can we live with some low level of the virus and hope that we keep the lid on it, but maybe have to go back into some kind of, isolation situation again down the track. And the view they take is that if we go into the eliminate, then we've got the best chance of Australians actually getting back out into the world, shopping, doing all of those sorts of things that will reignite the economy. So I kind of hope we'll do that. I think the signals we're getting from the Prime Minister are that actually that's the way he's leaning, because he's sort of talking about people not thinking they should get back out too early. But, I think the real test will come is about in what we see the government doing from here to really stimulate parts of the economy further. And I really hope that they see the importance of stimulating this part of the economy, because the biggest risk is that the entire digital economy once again becomes either divided up between the American and the Chinese, essentially, or basically a handful of very large digital platforms who just buy up the struggling undergrowth, as it were. So I would hope that doesn't happen, but that I think the government really does have a big role to play in stimulating a strong recovery. And I think they will. I think one of the good things, to be honest, Liberal governments tend to have bizarrely more license to spend harder, because Labor governments are always accused of overspending, so the Liberal governments can kind of get away with it more easily. So ironically, I suspect we've got a better chance under a Liberal government of seeing more spending by the government to actually stimulate the economy in a kind of Keynesian recovery.
Thanks, Simon. We've started to get some questions coming through, but I might just ask this final question that we have to all the panelists, and we might do one of those speed answering rounds. But the last question that we have is, as far as fintechs, should we think about scaling internationally if there is an opportunity, or do you think now the time to really just focus on the local market? So I'm going to ask, if we can do it, quick answer on this one, but I'll go through. Simon, what do you think? If you've got the opportunity to grow internationally, take it, or do you think it's, a bit more risk averse focused, stay focused on Australia?
I would say if you're global day one, you should already be scaling internationally. If you're not one of those companies, it should be the last thing from your mind, in my view. You should be focused on this market and focus on your sustainability.
Thanks, Simon. James, what do you think?
Yeah, listen, I agree with that. I think most fintechs sort of know pretty well from day one whether they're going after a local market or an international market. I think we'll start to see more models emerge out of this that are international focused. I think there'll be more people working on fintech infrastructure and back-end pieces that are naturally more inclined to a global market. But I think if you've been focused locally until now because that's where your market is, it would be pretty silly to go and try and break into another consumer fintech markets.
Melissa?
Yeah, I mean, I agree with what Simon said, with the caveat that it's very much a case-by-case basis. I mean, I think of a couple of heads over heels companies that are telehealth companies, and they're going gangbusters. So why wouldn't they use this opportunity to expand? But for the most part, anything you're doing outside of your core, it probably doesn't make sense if you're still relying on external capital to grow.
Mm. Okay, so thank you, panelists, for taking the questions from myself and Fintech Oz. In the Q&A, we've got one question now that's come through from Tony Zabel. He's posed the question for all speakers, but the first part of the question, with the rising number of neobanks and payment providers in Australia, do you see a possible consolidation or higher M&A activity within these areas? So we've got a couple of minutes, so might pose it to everyone.
Yes. I think companies should be thinking about consolidation. If you've got peers in your market, now's the time to be thinking about it, because your peers will. And the last thing you want to be is the last person to move.
Okay, second part of that question. And how do you, from Tony, and how do you see fintechs dealing with open banking implementation?
Well, I don't think that has changed. We're still, I know NAB's still very focused on how do we make sure we're complying with the timeline and working with fintechs. Probably things might get pushed back a little just because of fewer resources, but I don't think that's changed. I mean, Australia is going down that path. Nobody thinks we're not going down that path. And I know we're working hard at NAB, and our portfolio companies, one that we share with Simon at Reinventure, is working hard to enable that to happen faster.
Okay, we've got a few more questions coming in. We've got, let's say we've got 2 more minutes to take them. So David Engel has said, with the shift in focus from growth to profitability, how does this impact how VCs look at valuations? And then the second part of that question, how does this differ for portfolio companies versus non-portfolio companies?
I don't think you're suddenly going to see VCs jumping up and down about EBITDA multiples instead of revenue multiples or other sort of valuation methodology. I don't think the pendulum will swing quite that far. I think you're right, the shift will be, it's a bit of nuance, so it's not shifting just from growth to profitability, it's really a shifting of a focus from growth at all costs at questionable unit economics to a focus around sustainable growth, so on stronger unit economics, which arguably should have been the focus all the way along. But I think as a industry, VC probably let that slip a little bit. Anecdotally, the valuation stories that you hear coming out of the US and even here reflect a bit of a slowdown. I don't think it's really impacted it as yet. I think there's an expectation that it'll come down, but I think these things take a while to come through the portfolio, to come through the ecosystem. I think there'll be a narrower set of, there will be a set of companies that are able to raise on the same valuations, or at least the same sort of multiples of revenue and growth that there have been. I think that number, just that set, probably narrows down. And so I would not be surprised to see, some increasing numbers of really large valuation that probably will surprise people, to be honest, because they'll be it'll be more public, and it'll be more amazing that some of these companies have been able to get these valuations. But there is a lot of dry powder, and there will be that narrow set of companies who still continue to raise at pretty high valuations.
I was positive we'd get a question about valuations. I think it's something that all the founders, you know, we're keen to find out about. But 3:58, so we've got some more questions, but this was the end of our session. So I'm going to say thank you to all the panelists. I know Rebecca's going to say that, but I just want to say thank you because, you know, mental health has been a really big issue, I think, for founders going through the right sizing and looking at changes in the company that we've had to make. Where they're people who we are actually close friends with, not just employees. And so I know that I've had great support from my investors, and for me it's proven to be a really great time. You know, I picked the right investors, and I've got some really great support to help me navigate this. So I think it's great that, you know, you've got close relationships, you know, hold those investors tight, you know, and I think my advice would be, yeah, hold onto your investors tight, because I think they've got such experience and advice to help you navigate what's up ahead. And I've learned so much already today. So thank you, and handing it over to Rebecca.
Thank you, Catherine. I just want to, on behalf of Fintech Australia, thank all our panelists and Catherine for today's discussion and for giving up their time. I would ask the attendees to also thank you, but it's a little different on the webinar. So on behalf of Fintech Australia, we'd like to thank you all for giving up your time and your involvement, and always willing to lend a hand to our organisation. So thank you all. And on that note, goodbye, and I hope to see you all very soon. Thank you. Bye.
Thank you, Rebecca.
Thanks, Catherine.
Thank you all.
Bye.
Thanks, Catherine.
See you in person soon.
See ya.